All right, lock in for the next few minutes because what I'm about to walk you through is not opinion and it's not theory. This is a live market signal flashing right now, and it's one that historically appears only before major financial dislocations. Credit spreads are widening fast. Not gradually, not calmly, but aggressively. That tells us something very specific. The people who lend money for a living, the most risk-aware participants in the system, are pulling back. They're demanding more compensation, or they're refusing to lend at all. That behavior doesn't happen without reason, and when it does, it usually means the system underneath the market is starting to strain. Most investors never pay attention to credit markets, and that's a mistake. Stocks get headlines. Crypto gets hype. Real estate gets dinner table conversations. But credit is the plumbing of the financial system. When it flows freely, everything looks fine on the surface. When it slows, pressure builds quietly. And when it freezes, things break fast. Credit spreads are one of the earliest indicators of that pressure. They don't react to emotion, they react to risk. And right now, risk is being repriced in a way that suggests something fundamental is shifting beneath the market. Let's simplify what a credit spread actually represents. At its core, it's the price of fear. It's the extra return a lender demands for taking risk instead of lending to the safest borrower available. When spreads are tight, lenders are relaxed. They believe defaults will be rare. When spreads widen, lenders are nervous. When spreads jump suddenly, lenders are preparing for losses. This isn't about forecasting recessions or guessing policy moves. It's about how much confidence exists inside the system. And confidence, once it starts to erode, rarely stops on its own. What makes the current move in credit spreads so concerning isn't just the level, it's the speed. These moves are happening faster than they typically do during normal economic slowdowns. That tells us this isn't just a growth scare, it's a balance sheet problem. Lenders are looking forward and realizing that a large number of borrowers will struggle to refinance their obligations at today's rates. They're seeing maturity walls approaching. They're seeing leverage built during years of cheap money collide with a much higher cost of capital. And they're adjusting now, before defaults become visible. This is how every major credit event begins. Not with bankruptcies, not with headlines, but with reluctance. Banks hesitate, bond buyers step back, terms tighten quietly, liquidity thins. The system still functions, but with friction. That friction is dangerous because modern economies are built on constant refinancing. Corporations roll debt, governments roll debt, consumers roll debt. When rolling becomes expensive or impossible, stress moves fast from spreadsheets into real life. Credit spreads widening are the first public sign that this process is underway. To understand why this matters so much today, you have to look at the debt structure of the global economy. We are operating at debt levels that have no historical precedent outside of wartime. Governments, corporations, and households all increased leverage during years of near-zero rates. That leverage only worked because money was cheap and abundant. Now that the price of money has risen, that same leverage becomes a liability. Servicing costs rise immediately. Refinancing risk explodes. And lenders, seeing this clearly, adjust their behavior long before defaults hit the headlines. This isn't about bad actors or reckless speculation alone. Even well-run businesses are affected. Companies that borrowed responsibly at low rates are still exposed when those loans come due. A loan at 2% that resets at 6% changes the math completely. Margins compress, cash flow tightens, investment slows. And when many companies face this at the same time, the economy doesn't gradually cool, it stumbles. Lenders know this pattern well. That's why credit spreads move before earnings collapse and before unemployment rises. History reinforces this lesson repeatedly. Credit markets are always early, and they're almost never wrong. Before the Great Depression fully unfolded, credit tightened first. Before the financial crisis in 2008, spreads blew out months ahead of the equity collapse. Before every major systemic event, lenders sensed trouble before policymakers acknowledged it. That's because lenders don't rely on optimism. They rely on repayment. When repayment becomes uncertain, they protect themselves. What we're seeing now fits that historical pattern far too closely to ignore. Another critical factor here is real interest rates. For years, borrowers benefited from negative real rates, meaning inflation exceeded borrowing costs. That environment rewarded leverage and punished caution. Now that real rates have turned positive, the rules have changed. Debt is no longer self-liquidating through inflation. It has to be paid down with real income. That shift is brutal for highly leveraged systems. It exposes weak balance sheets quickly, and it forces lenders to reassess risk across the board, not just in the most obvious trouble spots. This is why stress is appearing simultaneously in multiple areas. Commercial real estate, private credit, leveraged buyouts, and speculative corporate borrowing are all feeling pressure at the same time. These sectors thrived on cheap money. Without it, their economics weaken fast. Credit spreads reflect that reality in real time. They're telling us that the era of easy refinancing is ending. And when refinancing ends, defaults don't need to spike immediately for damage to occur. The slowdown alone is enough to create systemic strain. What complicates the situation further is the position governments are in. Public debt levels are extremely high, and political systems are not prepared for austerity. That limits policy flexibility. Central banks face a dilemma: ease too aggressively and risk reigniting inflation. Stay tight and risk triggering a credit event. Markets are beginning to price in that conflict. Credit spreads widen when lenders believe policymakers are boxed in. That's exactly what we're seeing now. The system is approaching constraints it hasn't faced in decades. This is where many investors make a critical mistake. They assume central banks will step in and fix everything, as they have before. But interventions work best when balance sheets are healthy and trust is high. When debt is extreme and inflation is already a concern, intervention becomes less effective and more destabilizing. Lenders understand this. They know that bailouts don't eliminate losses, they redistribute them. That's another reason spreads widen. It's a recognition that risk can no longer be socialized as easily as it was in the past. Now, let's talk about opportunity. Because dislocations don't just destroy wealth, they transfer it. When credit spreads blow out, assets don't fall equally. Quality gets punished alongside junk. Liquidity disappears temporarily, even from solid businesses. That creates mispricing. Investors who understand balance sheets and cash flows can acquire strong assets at distressed prices. This is how asymmetric returns are generated, not by chasing momentum, but by providing capital when others can't or won't. Credit stress is painful, but it's also fertile ground for disciplined investors. At the same time, inflation risk remains unresolved. If credit stress forces policymakers to ease, inflationary pressures return. That creates a second layer of opportunity. Assets tied to real production, tangible value, and pricing power tend to outperform in that environment. Energy, commodities, infrastructure, and real assets historically benefit when financial assets struggle. This isn't about speculation, it's about aligning with structural incentives. When money is debased to stabilize the system, real assets absorb the excess. There is also a defensive side to positioning, and it matters just as much. During periods of credit stress, trust becomes fragile. Financial claims are only as good as the system backing them. That's when assets with no counterparty risk become valuable. Not because they generate yield, but because they preserve purchasing power when confidence wavers. History shows that in every major credit event, capital flows toward perceived safety, even if that safety produces no income. Preservation becomes the priority. The biggest mistake investors make during these periods is reacting too late. By the time defaults spike and headlines turn alarming, prices already reflect the risk. The opportunity exists in the early phase, when signals are clear, but consensus is still complacent. Credit spreads are one of those signals. They don't wait for confirmation. They anticipate it. That's why paying attention now matters. The window for intelligent positioning closes quickly once fear becomes widespread. This environment demands selectivity, not panic. It's not about selling everything or betting on collapse. It's about reducing exposure to fragile balance sheets and increasing exposure to resilience. Companies with strong cash flows, low leverage, and real assets will survive. Those dependent on constant refinancing may not. Credit markets are already making that distinction. Equity markets just haven't caught up yet. That lag is where opportunity exists for those willing to think ahead. Another critical adjustment is time horizon. Short-term volatility will be high. Liquidity will be inconsistent. Prices will overshoot in both directions. Investors focused only on short-term performance will struggle. Those focused on multi-year outcomes will find value. Credit-driven cycles don't resolve in weeks. They play out over quarters and years. Understanding that helps avoid emotional decisions and allows capital to be deployed strategically rather than reactively. It's also important to stay flexible. Conditions will change. Policymakers will respond. Markets will rally and sell off violently. Credit spreads themselves will fluctuate, but the underlying constraint remains debt. Until leverage is reduced or inflated away, stress will resurface repeatedly. This isn't a one-time event, it's a process. Investors who recognize that adjust continuously rather than anchoring to a single narrative or forecast. The takeaway here is simple but uncomfortable. The financial system is less stable than it appears on the surface. Credit markets are signaling that clearly. Ignoring those signals doesn't make them go away, it just delays response. Preparation isn't pessimism, it's discipline. Those who prepare early preserve optionality. Those who don't are forced to react under pressure, usually at the worst possible moment. Every major wealth shift in history has followed this pattern. Early signals, general denial, sudden repricing, and then a new equilibrium. The winners aren't the ones who predict exact dates. They're the ones who recognize structural stress and position accordingly. Credit spreads are flashing that signal now, not subtly, not quietly, clearly. The question is whether you're willing to listen. This moment will be remembered differently depending on how it's handled. For some, it will be a period of loss and confusion. For others, it will be a period of disciplined action and long-term gain. The difference isn't intelligence, it's attention. Paying attention to the right indicators instead of the loudest narratives. Credit markets don't lie. They don't need to. They simply price reality ahead of time. We are not at the end of this cycle yet, but we are past the point of comfort. The era of effortless leverage is over. Capital will become more selective. Risk will be priced more honestly. That transition is never smooth, but it is navigable. Those who understand how credit drives the system will have a significant advantage over those who don't. So the final question is simple. Are you positioned for a world where credit is scarce, expensive, and selective? Or are you still assuming the old rules apply? The market is already answering that question. Credit spreads are the message. Everything else is noise. Pay attention, stay disciplined, and stay ahead of the curve. That's how capital is protected and grown when the system starts to strain.